Hi, thanks so much for joining in to this special broadcast on NDTV Profit. My name is Mathew. The start of a new financial year is a great time to take stock of your investment strategy, and we talk about equity on every other show on this platform. On this show, though, we'll talk about fixed income and what are the factors that will cause interest rates to move in the new financial year, how much can you predict, and most importantly, how can you benefit? That's what we're covering today. My first guest today is Mahendra Kumar Jajoo, the CIO Fixed Income of Mirae Asset Investment Managers. Thank you so much, Mahendra, as always, for speaking to me and for speaking to NDTV Profit. Let me start with a coverage of the context that we're in right now. We're just about a week, or less than a week, in fact, away from the RBI's rate decision. There's a lot that is playing out on the global, in the global setup as well. We're watching for the Fed and when the next move is taking place. So let's break this down. Let's first talk about the global scenario, and let's first talk about how you, as a manager of fixed income portfolios, are looking at the Fed.
Fed is very clearly inclined towards rate cut in the second half of the year. In the US, the inflation has come down significantly from a peak of about 9% to now at about 3 to 3.5%. It is still very far away from the Fed's target of 2%, but then everything is pointing to continued softness in inflation. For example, the oil prices have not moved up meaningfully in spite of so much of geopolitical tension. So most of the commodity prices are pretty well behaved to suggest that inflation should continue to remain benign. And therefore, given the fact that in the last leg of the inflation going up and the rate hike cycle, the Fed moved very aggressively. The last 100 basis points of rate hike that Fed did from 4.5 to 5.5% is something which is a very low hanging fruit for the Fed to reverse. And therefore, I believe that in the second half of the year, which is sometimes in June or July, we should see the first rate cut from Fed. And that's pretty much, I think the market also seems to be discounting at point in time.
From the perspective of managing a fixed income portfolio, I'm just curious, and we'll talk about the investor perspective also down the line, but in a falling interest rate scenario, is it relatively less challenging than it is in a rising interest rate scenario, or are they both equal?
I think markets are always equally challenging. So, how many people who have missed the big rally in the equities market? So, in a falling market, the fear is of getting trapped and not being able to exit in time. In a rising market, there's a fear of missing out. So, I think the opportunities are on both sides. Having said that, why it is easier for the fund managers in India, in particular in fixed income, to have a falling interest rate scenario is that everybody makes money and everybody is happy. We are generally a long only market with a very limited number of players. So when the interest rates are going up, there are limited tools available for hedging. We are typically a long only investors as a mutual fund, and therefore when the interest rates are going up, our returns don't look that attractive. So I think in that sense, it is easier to have a situation where the interest rates are falling, but from market perspective, both are equally challenging.
Let me add to that question then, because there are people that watch this market, and I'm not talking about professionals like yourself. I'm talking about people that reasonably understand the bond markets. And what they think is that if they can predict the peak of an interest rate cycle, and generally you have fair warning, then you can't go wrong when you, say, for example, take duration at that period, and if you have enough time horizon ahead of you, because at some point or the other, you will make money. Is that the right approach?
I think that is an absolutely correct statement, that if you can predict the peak of the interest rates, then obviously you're going to make a lot of money. But I think that prediction is a very challenging thing. It is very difficult because typically when the rates are going up, then people tend to think that it will continue to go up and vice versa. Now, there is another challenge that people need to, factor in that in US, for example, the yield curve is inverted. So Fed is at 5.5%. The 2 year is already around 4.5%, and the 10 year yield is at around four quarter broadly, big numbers now. And then uh, the 10 year has moved in the region of 3.85 to 4.5% for a brief while to even 5% in the last 1 year. So even if you call the peak of the Fed rate at 5.5%, right, it has been close to now almost 6 months that Fed has not done anything. Market has done a lot of things. So there is a lot of missed opportunity in that sense, or a lot of hit to the portfolio that could have taken place in that sense. So I think being able to predict the peak of the interest rate is just one part of the entire process. Let me give you one live example. Last year when the interest rate environments were very, very, difficult, uh, and we used to say to everyone who cared to listen that look at around 7.5, 7.6 10-year yield in India seems to have peaked, and therefore it is a good time to start looking at target maturity funds, which were very popular at that point in time. And every time people will say, no, no, we are going to wait for 8%, we are going to wait for 7.75%. 1 year down the line, we know that 7.5% was the peak of 10 year in the current cycle. But then it was very difficult to take advantage of that because it is very difficult for us to then be able to convince people. So there are multiple dimensions of the entire process, and the ability to predict if one can the peak of the interest rate is just one part. We believe that if somebody is following an investment process, for an investor, that is important. Being able to predict the peak is just one trading call which can be right. So I don't think that is the key to success. Key to success is a systematic approach, a disciplined approach to the market, and then top it up with the good risk management system.
Got it. A few aspects will probably help investors make the right judgment call as things stand. We briefly talked about the Fed, but just to round off that conversation, Mahendra, you have a few commentators that are saying that with inflation not having come off as substantially as it should have, and we saw the latest reading on the PCE, and that still continues to be a little elevated. It is moderating, no doubt about that, but it hasn't gone to the extent that the Fed probably would want it to. And on the other hand, you see the resilience in the economy from the jobs numbers and all of the other high-frequency indicators in the US. Some people are saying, what is the need and what is the urge to cut too quickly? And so would you say that in this current environment, one of the risks on the global end is that the Fed does not move at all, even in this, in 2024, instead of 2 or 3, it might just cut once?
So I think that's a fair argument. But as I said, look, there is no way that the Fed target of 2% on the inflation is achieved in the current year. I don't see that happening, honestly. But then you have to look at one environment. The inflation has fallen from 9% to 3%, and the interest rates have gone up from 0 to 5.5%, right? So today at 5.5%, Fed rate is almost 2%, 2.5% into positive real rates. That is something which an economy, a mature economy like US with so much of debt, is hardly going to be able to tolerate. So by not cutting rates, is the Fed going to cause incremental damage to the economy, or is it going to help the economy maintain the current momentum, is one factor to be considered. Now, let's also understand the fact that when we are talking about Fed cutting rates, we are talking of 3 rate cuts, or you're saying maybe possible 1 rate cut. So all we are saying is the beginning of the rate cut cycle to bring it back to a more neutral level. So as I said earlier in my uh, comments, that the last 100 basis points of the rate hike that Fed did in the last leg of the cycle was very aggressive. And from those times, the inflation has fallen very meaningfully. So if the inflation is not going to go back to 2%, it's not going to go back to 9% also. Therefore, at 5.5%, I think it's a low-hanging fruit for Fed to cut rates. Now, we don't know whether they will cut or not. Their guidance right now is clearly for a rate cut in second half of the year. All we can say is that, look, if they don't cut, then maybe they will possibly push the economy to a slower trajectory than it would otherwise have. So these are the things that we can have control on. But whether Fed will cut or not, we don't know. Whether Fed should cut, in my view, very clearly,
Yeah.
yes, some part of the rate hikes can be reversed.
So the reason I've been stressing so much about the Fed is that I wanted your perspective on whether or not the RBI can move in isolation, ignoring what the Fed is doing. And of course, you've had the Reserve Bank of India governor on multiple occasions. He will probably reiterate this on Friday, that the RBI and the Monetary Policy Committee of the Reserve Bank of India does not make its decisions based on what another central bank is doing, but can it cut when the Fed has not cut?
I think this needs to be looked at into two parts. So I think when the governor says that our monetary policy is largely focused on domestic factors and we don't cut or hike rates because the other central banks are doing, I think that's absolutely the correct situation. And I think it's very interesting. Today, RBI has completed 90 years and there was a big celebration. And I think the way the RBI has conducted the monetary policy, especially since the COVID time, it has been an incredible positive experience. And therefore, RBI is today recognized as one of the best central banks in the world. But then, keeping that aside, the domestic policy is not going to have a rate cut because Fed is cutting rate. But to the extent that if the Fed cuts rates or if the Fed hikes rate, it has impact on the global environment. It has therefore the cascading impact on the domestic economy. There will be some, impact. And Fed is the mother market for the money markets across the world. When it's a famous saying that when Fed gets cold, the rest of the world sneezes. So you cannot isolate ourselves completely and say, look, I don't care what the Fed does or doesn't do. We care what Fed does, but then we have our independent assessment of domestic factors also. And let me give you one quick example, if you permit me a second. In 2022, when RBI started hiking rates, it coincided with Fed's rate hike cycle because that's what the domestic requirement also was, that look, when the Fed has started rising rates, it will have impact on the global liquidity, global cost of capital, and therefore it will have impact on domestic factors, and therefore we also started hiking rates. And you can say that, look, RBI started hiking rate because Fed has started hiking rate. But look at February 23, from February 23 to February 24, RBI has been on a pause, whereas the Fed has hiked rates 4 times by a cumulative of 100 basis points in the last 12 months. So in the last 12 months, RBI reached its destination quickly, and once it reached 6.5%, it assessed that, look, now we don't need to hike rates because our inflation is largely
Under control.
better behaved, etc. But for the Fed, the inflation continues to pose challenge. So RBI in the current cycle itself has shown that it is more focused on the domestic factors, but it also considers the global factors which can have domestic implications. So we hike
So,
rates alongside Fed,
so
and we did not hike.
the follow-up, Mahendra, to that question is that now that we've established it cannot move in isolation, it is focused on domestic factors, but we've looked at core inflation and the print of core inflation over the last few months, and we've seen it trending far below what we've seen over the course of the last several months. And the problem really in the headline number seems to be food inflation, which to a large extent one would argue is supply side driven. And so from that perspective, are we heading into a scenario where that weakness in core inflation will translate into a slowdown in growth? And so therefore, is the RBI required, or will RBI soon be required to act? And therefore, can we see a change in the bond yields? We're already seeing it at 7.06, whereas as you pointed out, not too long back, it was at 7.5.
I think overall macro assessment is very clear that the next move of the Reserve Bank will have to be a rate cut. Now, we know that the food inflation is a challenge. it's very volatile, but then it's real. And therefore, at different points, the food inflation can have different impact. Sometimes the central banks ignore it, considering it as highly volatile and not structural in nature. Other times, when there is a risk of the food prices getting generalized, then central banks might want to consider the impact of that into the broader inflation index. At this point, we are looking at the core inflation, easing significantly, and it is well below 4% now. But then you also need to understand that the core inflation has remained very sticky for better part of the last 3 years. So in the last 3 years, when the core inflation was at above 6%, our rates were not anywhere close to 7.5%. For better part of that time, the rates were, maybe more like 4.5, 5%, then to 6%. So there is a little bit of lag on two counts. One is that the average inflation in the last 4 years and the average uh, interest rates in the last 4 years are still balancing out. Something of the sort that is also happening in US, which is why the Fed is being a little more patient with the cutting of the rates.
Yes.
And the second part is that there is a lag effect with which the core inflation is easing. It's historically known that if the core inflation remains very high and the uh, headline inflation is trending down, then over a period of time the core inflation will start to sync with the headline inflation. So these
Fair
are
point.
some of the arithmetics of
So,
the inflation.
so therefore,
So just 10 seconds more.
yeah,
Therefore, I think the clear direction, in my view, for RBI is to cut rates second half of the year. But the margin for which is very shallow.
got it. The last point, and knowing that we're likely to see significant inflows because of the inclusion of India and a couple of bond indexes as well, the last point is, how do you see the yield curve developing? We're already seeing on the longer end the yields coming off, and so to that extent, I would think that there is a flattening that has already taken place. How do you see the yield curve progressing, and what, according to you, should be the strategy that investors should adopt in this given scenario?
So, as you rightly said, that the market is already expecting rates, and therefore, to some extent, that's reflected in the flat yield curve. So, the yield curve is flat at the longer end because of the expectations of the rate cut, and the yield curve is very flat at the shorter end because of the tight liquidity conditions and the scramble for deposits by the banks. And now, in the last 1 year, the US inflation has come down, and their interest rates are still high. So the inflation has fallen from 9 to 3. The Fed rate has gone from 0 to 5.5 in the US. In India, the interest rates have come to, I mean, the repo rate has come to 6.5%, but the inflation has largely remained unchanged at around 5 to 5.5% in the last 3 years. Therefore, the scope for the Reserve Bank to cut rates, in my view, is rather shallow, because the differential between the US and the India key policy rates is just about 100 basis points right now. And the inflation equation is against India, where our inflation is 5.5%. US inflation is at 3.5%. So I believe that the rate cut cycle that the Reserve Bank may, have will be very shallow, and therefore the impact at the longer end will be in the first leg of the rate cut cycle. So first rate cut, or the background, or preamble to that, will be driven by the easing of the rates at the longer end. Some part of that we are seeing. At the same time, when the RBI turns accommodative and in the new year with the government spending, the liquidity in the system will improve, and therefore the focus will then shift to the 3 year, 5 year of the segment of the income. Therefore, I believe that after the first leg of strong rally in the 10 year, 15 year segment, gradually the income will become to steepen from the bullish side, which means the 3 to 5 year and the 1 year segment will come down. Therefore, the curve will become a regular, positively sloped yield curve in 6 months' time.
Okay, all right. Thank you so much, Mahendra, for joining in and having a conversation that we don't have enough, I think, on our programs. Thank you so much for taking the time.
Thank you so much for inviting me. Thank you.
My pleasure. We have to slip into a very quick break, but on the other side, we'll talk about what you should do with this information. How should you plan your fixed income strategy? Do stay tuned. Welcome back. You're watching a special show that helps you understand fixed income as things stand right now and what your strategy should be. Now, we've discussed what will likely happen on the interest rates in 2024, and my previous guest is of the opinion that we're likely to see interest rate cuts by central banks in the second half of 2024. With that information, how should you change your fixed income strategy, if at all? Amit Kukreja, founder of AmitKukreja.com, is joining in. Amit, thanks so much as always for taking the time. One, how should you plan your fixed income strategy on an ongoing basis? And two, as you would normally do in the equity markets where you see certain segments or companies moving and you make certain investments, with the interest rate cycle as things stand right now and your expectation of it moving, do you also use that information to make tactical investments in the fixed income market?
Yeah. So Alex, three parts to it. One, if you are looking for a more stable cash flows, then do not try to time the market with respect to rising or falling interest rates. Just get into fixed income products which are serving your purpose of regularity in your cash flows. But if you are looking for some opportunities where you may want to have a little bit of alpha with respect to being more aware of how the interest rates are going to go up or down, then you can get into long duration bond debt funds or even medium term debt funds where we have the interest rate risk coming out and playing in your flavor to give you alpha. But generally, I recommend the investors and the clients that look for what exactly is your need in the desire to have more alpha in your fixed income portfolio or from your debt funds portfolio. Do not go for a paper or a product which has the credit risk involved in it, or which has a company risk involved in it. So go for AAA rated papers or a predominantly AAA rated paper product, and go for a little bit of trends that you're seeing in the interest rates, and then get into the debt fund allocation as required.
So would you say that, like you do in your equity portfolio where you have a core and a satellite, you within your fixed income as well, and you first of all you have a longer term kind of a portfolio, but your satellite is what you use for your tactical bets or your tactical allocations, and what percentages can you look at here?
Yeah, so thanks for bringing up core and satellite structure. So in core, something which is more regular with respect to cash outflows, then you can have a layer of satellite where you can have a fixed income safer paper, and then you can have the tactical allocation. So I would say if you are purely designing a fixed income portfolio, then at least 60% should be core. The other 20 to 30% can be something where you get the advantage of staying there and deferring your taxes by accumulating the capital gains. And lastly, 10 to 15% where you have the interest rate playing a game of a generating kicker for you in your fixed income portfolio.
Okay, so that core, what would you fill that core with? Would you talk about, say, your government bond funds? Would you talk about corporate bond funds? Or would you also talk about target maturity funds?
So I would go with target maturity funds, and I don't mind having some of the corporate bond funds as well if they are really good company papers in the mutual fund space and they are a well-managed portfolio which is done by the fund managers. But overall, something which is safe. As I say, in a fixed income portfolio, go for SLR. S stands for safety of your corpus, L stands for the liquidity, and R stands for the rate of return. And add to it the advantage of taxation, because in debt funds, you are deferring the taxes until you are realizing the profits. And you can also use the capital gains to offset some of the capital losses in the other financial products if you have incurred any. So go for corporate bonds and target maturity funds as the core.
Fantastic. I think that more or less covers the strategy. And as you pointed out, don't necessarily jump the gun based on what you might think happens with interest rate and changes by the central banks, and have a more long-term strategy. And I think you've laid that out very well. Thank you so much, Amit, for taking the time.
Thank you, Alex.
And that brings us to the end of this particular edition, or rather special broadcast on fixed income. If you've got questions for us, you can write to us on that number that you see on your screen, and lots more coming up over the course of the day. This is NDTV Profit.